So I'm sitting here on my couch at 11 p.m. on a Tuesday, right? Got a beer that cost me $4. $4! For a single can, what is this, liquid gold? And I'm scrolling through my brokerage app. You know, that thing I opened 3 years ago after my buddy Dave wouldn't shut up about investing at the shop. And I'm looking at this thing called the S&P 500 Index Fund, and my account is up like 18% from last year. 18%, I did absolutely nothing. I mean, I went to work. I fixed Mrs. Henderson's broken toilet. I argued with my health insurance company for 45 minutes about a bill they already said they'd cover. I ate too much pizza. I fell asleep watching Netflix with my boots still on twice, and this money just grew by itself while I was being a regular human disaster. I've got lower back pain. I've made every stupid financial mistake you can imagine. And tonight I'm going to explain the S&P 500 to you like you're my younger cousin who just got their first real paycheck and is about to blow it all on something incredibly stupid. This is the laziest way to get rich that actually works. And I'm going to tell you exactly why it works, how it works, and why every guru selling you a course on day trading or crypto or real estate with no money down is basically pickpocketing you while you're distracted by shiny objects. Let me start with the reality check that nobody wants to hear, but everybody needs to. It's January 2026. The median household income in America is about $78,000. Sounds decent, right? Wrong. After taxes, after health insurance that covers basically nothing until you hit your $6,000 deductible, after rent or mortgage, after car payment, after the electric bill that somehow keeps going up, even though you're using the same amount of electricity. After groceries where a dozen eggs costs $5 and a pound of ground beef is $7. After gas. After internet that Comcast keeps raising by $10 every 6 months for no reason. After your phone bill. After the streaming services you can't cancel because you need something to watch to forget about all these other bills. You've got maybe $300 left at the end of the month, if you're lucky. And that's if nothing breaks. That's if your car doesn't need new tires. That's if your kid doesn't need braces. That's if you don't get sick. That's if life doesn't happen. And then you go online, and every single person is screaming at you about what to do with money you don't have. Buy crypto, buy gold, buy real estate, start a side hustle, learn to trade options. Wake up at 5 a.m. and meditate and drink green smoothies, and somehow that'll make you rich. And you're sitting there thinking, I just want to retire someday without eating cat food. Is that too much to ask? The answer, by the way, is apparently yes. It is too much to ask in 2026 America. But we're going to try anyway. Here's what actually happened to me, and this is important because I want you to understand that I am not special. I am not smart. I am not disciplined. I am not some finance wizard who reads the Wall Street Journal every morning while doing yoga. I am a regular guy who got lucky exactly once by accidentally doing the right thing after doing the wrong thing for 20 years. Back in 2022, I had about $8,000 in a savings account earning 0.05% interest. You know what that means? That means the bank was paying me $4 a year to hold my money, while they turned around and loaned it out at 8% interest to other people. I was getting robbed in slow motion and I didn't even know it. Meanwhile, inflation was running at 8% that year, so my $8,000 could buy 8% less stuff every single year, which means I was losing about $640 in purchasing power annually, while the bank paid me $4 for the privilege. I was going backwards at $636 per year, and I thought I was being responsible by saving. Then my buddy Dave, same guy I mentioned earlier, works as an electrician, not a finance guy, just a regular dude. He tells me, Bill, you're being an idiot. Put that money in an S&P 500 index fund and forget about it. And I said, what the hell is an S&P 500? Sounds like something that'll steal my money. And he said, it's basically buying a tiny piece of the 500 biggest companies in America all at once. You're betting that America doesn't completely collapse. That's it. That's the whole strategy. And I'm thinking, that sounds too simple. What's the catch? The catch, and I'm going to be brutally honest here, is that there's no catch. The catch is that it's boring. The catch is that it doesn't make you feel smart. The catch is that you can't brag about it at parties. The catch is that it requires patience, which in 2026, when we can't even wait 3 seconds for a web page to load without getting angry, is apparently the rarest resource on earth. But I did it anyway because Dave wouldn't shut up about it and I was tired of being broke. I opened a brokerage account, took me like 15 minutes, which was surprisingly easy, and I bought shares of something called VOO, which is Vanguard's S&P 500 Index Fund. Cost me about $400 per share back then. I put in $7,000, kept $1,000 in savings for emergencies because I'm not completely stupid. And then I did the hardest thing I've ever done financially. I forgot about it. I didn't check it every day. I didn't panic when the market dropped. I didn't try to time it. I just let it sit there like a potato in the ground that you plant and then come back to dig up later. Now let me explain what the S&P 500 actually is, because most people hear index fund and their eyes glaze over like I'm explaining calculus. The S&P 500 is basically a list of the 500 largest publicly traded companies in America. We're talking Apple, Microsoft, Amazon, Google, Tesla, Walmart, Coca-Cola, McDonald's, Visa, Home Depot. Companies you've actually heard of, companies that make stuff you actually use. When you buy an S&P 500 index fund, you're buying a microscopic slice of all 500 of these companies at the same time. You're not picking winners. You're not trying to predict which tech startup is going to be the next big thing. You're just saying, I believe that the American economy, on average, over a long period of time, will probably keep growing, because it has for the last 100 years, and I'm too tired to try to outsmart it. And here's the beautiful part that nobody tells you. You don't have to be right about individual companies. You don't have to predict that Apple is going to crush it this quarter or that Tesla is going to fail, because the S&P 500 automatically adjusts itself. Companies that get too small fall off the list. Companies that get bigger get added. It's self-cleaning. If Sears goes bankrupt, which it did, it just disappears from the index and gets replaced by something else. You don't have to do anything. You don't have to make decisions. You don't have to read earnings reports. You don't have to watch CNBC and pretend you understand what forward PE ratio means. You just own a piece of the entire American corporate machine, and you let capitalism do what capitalism does, which is grow over time while causing maximum anxiety for everyone involved. Let me give you the numbers that made me realize I'd been wasting my life. From 1928 to 2023, so basically 100 years of data, including the Great Depression, World War II, the Cold War, the dot-com crash, 9/11, the 2008 financial crisis, COVID, all of it, the S&P 500 has returned an average of about 10% per year. Not every year. Some years it's up 30%, some years it's down 20%. But on average, over long periods of time, about 10% annually. Now, you might be thinking, Bill, 10% doesn't sound like that much. Oh, but here's where the magic happens. And by magic, I mean math. And by math, I mean the most powerful force in the universe that your high school teacher tried to explain, but you weren't paying attention because you were texting someone in third period. It's called compound interest, and Einstein supposedly called it the eighth wonder of the world, which I thought was a fake quote until I looked it up. And apparently maybe he said it, maybe he didn't, but either way, the concept is real, and it will blow your mind once you actually see it work. Here's how it works. Let's say you invest $10,000 in the S&P 500 today. In year one, at 10% growth, you've got $11,000. Cool. That's $1,000. You could buy a decent used laptop or a plane ticket or 2 months of groceries, not life-changing. But in year two, you're not earning 10% on your original $10,000. You're earning 10% on $11,000. So now you've got $12,100. And in year three, you're earning 10% on $12,100. And this keeps snowballing. After 10 years, your $10,000 is now about $26,000. After 20 years, it's $67,000. After 30 years, it's $174,000. And after 40 years, it's $452,000. You put in $10,000 once, you didn't add a single dollar, and 40 years later, you're almost half a millionaire. That's not speculation. That's not gambling. That's just math and patience. But here's where it gets really good. And this is the part that made me want to punch my younger self in the face for not figuring this out sooner. What if instead of investing $10,000 once, you invested a little bit every single month? This is called dollar cost averaging, which is a fancy term for I don't have 10 grand lying around, but I can scrape together $200 a month. Let's say you invest $200 per month into the S&P 500 every month for 30 years. That's $2,400 per year. Over 30 years, you've personally contributed $72,000 of your own money. But because of compound growth at that 10% average annual return, your account isn't worth $72,000. It's worth about $452,000. You turned $72,000 into almost $500,000 by literally doing nothing except making automatic monthly contributions and not panicking when the market had a bad month. And if you can manage to put away $500 per month, I know that's hard. We'll get to how to actually do this. Over 30 years at 10% annual returns, you're looking at over $1 million. You will be a millionaire, not from winning the lottery, not from starting a tech company, not from buying Bitcoin at the right time, from putting $500 a month into the S&P 500 and watching TV for 30 years. This is the laziest wealth-building strategy that actually works. And I'm borderline offended that nobody explained this to me when I was 22 and could have been doing this for the last 20 years. Now, let me address the voices in your head right now because I had the same voices in my head when Dave first explained this to me. Voice number one, but Bill, what if the market crashes right after I invest? Great question. The market absolutely will crash at some point. Not if, but when. It crashed in 2008. It crashed in 2020. It'll crash again probably multiple times in your lifetime. And you know what happens every single time? It comes back. Always. Eventually. Because the S&P 500 is the American economy, and the American economy has a long track record of bouncing back from disasters. When COVID hit in March 2020, the S&P 500 dropped 34% in about a month. People were panicking, selling everything, certain that this was the end times. And if you had sold, you would have locked in those losses. But if you had just held on, or better yet, if you had kept buying during the crash, by August 2020, the market was back to where it started. By the end of 2020, it was up. By 2021, it was way up. The people who got rich weren't the ones who tried to time the market. They were the ones who didn't panic. Voice number two, but what if I need the money before 30 years? Then you don't invest it. This is important. The S&P 500 strategy is for long-term money. Money you don't need to touch for at least 5 years, preferably 10 or more. If you're saving up for a car you want to buy next year, this is the wrong place for that money. Keep that in a high-yield savings account earning 4 or 5% with no risk. The S&P 500 is for retirement money, for I want to not work when I'm 70 money, for I want to give my kids a head start money. It's not for short-term goals. If you invest money you'll need in 2 years and the market happens to be down 20% in 2 years, you're screwed. Time is the key ingredient here. Time smooths out the volatility. Voice number three, and this is the big one. But Bill, I don't have any money to invest. I'm living paycheck to paycheck. I hear you. I really do. Most Americans are in the same boat. 63% of Americans couldn't cover a $500 emergency without going into debt as of 2024. And that number probably hasn't gotten better in 2026. But here's the truth that nobody wants to say out loud. If you're spending every single dollar you make, you will never be not poor. Ever. I don't care if you make $40,000 or $400,000 a year. If your expenses equal your income, you're broke, just at a different level. The game is not about making more money. The game is about keeping more of the money you make. And I know that sounds preachy. I know it sounds like boomer advice, but it's math. You cannot build wealth if you save $0. So what did I do? I tracked my spending for 1 month. Just 1 month. I wrote down every single thing I bought, and I found out I was spending $340 per month on stuff I didn't actually need. $90 on coffee shops because I was too lazy to make coffee at home. $60 on a gym membership I used twice in 3 months. $70 on streaming services I barely watched. $40 on food delivery because I was too tired to cook. $80 on random Amazon purchases that seemed important at the time but weren't. That's $340 per month. That's $4,080 per year that was just evaporating. Not on rent, not on food, on convenience and comfort and distraction. And look, I'm not saying you have to live like a monk. I'm not saying never enjoy anything. I'm saying that $340 per month invested in the S&P 500 for 30 years would turn into over $700,000. That's the actual cost of those coffees. Not $4, $700,000 in future wealth. Here's what I did, and you can do this too. I set up automatic investing. This is crucial. Every month, the day after my paycheck hits my account, $250 automatically transfers from my checking account to my brokerage account and buys more shares of VOO. I never see it. I don't have to make a decision. I don't have to remember. It just happens. And because I never see that money, I don't miss it. My brain adjusts. I live on what's left. This is called paying yourself first, which is advice so old and boring that everyone ignores it, but it's the only thing that actually works for people like me who have zero discipline. If you wait until the end of the month and say, I'll invest whatever's left over, there will never be anything left over. Life finds a way to spend every available dollar. You have to make the decision once, set up the automatic transfer, and then let the system run itself. And let me be clear about something else. This is not gambling. When people hear stock market, they think it's the same as going to a casino or buying lottery tickets. It's not. When you buy the S&P 500, you own real companies that make real products that real people buy. You own a piece of the iPhone in your pocket. You own a piece of the AWS servers that run half the internet. You own a piece of every Big Mac sold, every prescription filled at CVS, every purchase made with a Visa card. These are profitable businesses with billions in revenue. Yes, the price goes up and down based on emotion and news and Federal Reserve policy and a million other factors. But underneath all that noise, these companies are generating actual cash flow. Over long periods of time, stock prices tend to track the actual value and profits of the companies. This is why the S&P 500 has gone up for 100 years, because American companies, on average, keep finding ways to make more money. Now let's talk about the alternatives, because I've tried most of them and they all suck in their own special way. Real estate? Sure, if you've got a down payment for a house, which in 2026 is about 20% of $350,000 for a median home, so you need $70,000 just to start, plus you're taking on a 30-year mortgage at 7% interest. And you've got property taxes and maintenance, and the roof will need replacing, and the water heater will break, and you might get a nightmare tenant who destroys the place. Can you make money in real estate? Absolutely. Is it passive? Absolutely not. It's a part-time job. I looked into buying a rental property 2 years ago, ran the numbers, realized I'd be spending every weekend fixing toilets and dealing with late rent payments, and decided I'd rather just keep buying VOO. Maybe I'm lazy. Actually, definitely I'm lazy, but that's the point. Crypto? I bought some Bitcoin in 2021 because FOMO is a powerful drug. You know what Bitcoin did from November 2021 to November 2022? It dropped 70%. 70%, I watched $3,000 turn into $900. While crypto bros on Twitter kept telling me to zoom out and have fun staying poor. And yeah, crypto has had some incredible runs, and maybe it'll go to $1 million someday, and maybe I'm an idiot for not holding. But you know what the S&P 500 did during that same period? It dropped about 20% and then came back. Because the S&P 500 is backed by actual companies with actual earnings. Crypto is backed by whatever Elon Musk tweets on a given day. I'm not saying don't own any crypto. I'm saying don't bet your retirement on it. Day trading? Oh man, I tried this for 3 months in 2023. Thought I could outsmart the market, bought some stock tips from a guy on Reddit. Spent hours every day watching charts with little colored lines that supposedly meant something. You know what happened? I lost $1,600 in 3 months, which works out to about $21 per hour that I spent watching those charts, except I was paying to work instead of getting paid. Meanwhile, if I had just put that money and that time into the S&P 500, I would have been up about 12%. The data on this is brutal and clear. 95% of active traders lose money. 95%. The ones who win are either institutional investors with supercomputers and insider information, or they're lucky, and you can't tell the difference until after the fact. The house always wins in the short term, but in the long term, the S&P 500 just keeps grinding higher. Gold? It's been around for 5,000 years, sure, but from 1928 to 2023, gold has returned about 5% annually on average. The S&P 500 has returned 10%. Gold just sits there being shiny. Companies innovate, expand, hire people, develop products, and grow. I'll take the thing that does something over the thing that just exists. Individual stock picking? This is the one that gets people because it feels smart. It feels like you're taking control. You read some articles, you do some research, you buy shares of a company you believe in. And if you're right, you get to feel like a genius. But here's the problem. Even professional fund managers, people who went to Harvard Business School and have teams of analysts and spend 80 hours a week researching companies, even they can't consistently beat the S&P 500 over long periods of time. About 85% of actively managed mutual funds underperform the S&P 500 over a 15-year period. Think about that. People whose full-time job is picking stocks and they can't beat the index. What chance do you and I have? The answer is basically zero. We might get lucky occasionally, but consistently, over decades, no shot. So why does the S&P 500 keep winning? Because it's diversified. If you pick individual stocks, you might pick the next Amazon or you might pick the next Blockbuster. With the S&P 500, you own both, and when one fails, it gets replaced. You're protected from catastrophic losses because your eggs are in 500 different baskets, and you're positioned to capture gains from whatever sector happens to do well. Tech booming? You've got Apple and Microsoft and Google. Energy spiking? You've got Exxon and Chevron. Healthcare growing? You've got Pfizer and Johnson & Johnson. You're not trying to predict the future, you're just making sure you participate in whatever actually happens. Let me tell you about my neighbor Todd, because Todd is living proof that this works, and also because Todd makes me irrationally angry, even though he's actually a nice guy. Todd is 58 years old. Todd works as a mid-level manager at an insurance company, nothing fancy. He's not a CEO. He's not making millions, but Todd started investing in the S&P 500 when he was 28. Every single month for 30 years, he put away $450. That's it. That was his whole strategy. No fancy moves, no stock picking, no crypto, just $450 per month into an S&P 500 index fund. And you know what Todd has now? About $1.3 million. He's going to retire at 62 with a paid-off house and enough money to do whatever he wants for the rest of his life. And when I asked him how he did it, you know what he said? I just didn't screw it up. That was the whole trick. I didn't panic when the market crashed. I didn't try to get fancy. I just kept buying every month like clockwork and let time do the work. Todd is going to play golf 4 times a week and take his wife to Italy and basically live the retirement dream, because 30 years ago he made one smart decision and then never changed his mind. And here's what makes me want to throw something. I could have been Todd. If I had started at 28 instead of 40, I'd be in the exact same position. But I didn't, because I thought I was too smart for simple strategies. I thought I needed to find the secret. I thought there was some special trick that rich people knew and weren't telling the rest of us. Turns out the secret is that there is no secret. The trick is compound interest plus time plus not being an idiot. That's it. That's the whole game. So let me give you the actual step-by-step plan, because I promised you actionable steps, and I'm not going to waste your time with theory anymore. Step 1. Open a brokerage account. I use Vanguard because they invented index funds and their fees are stupidly low, but Fidelity and Charles Schwab are also fine. Takes 15 minutes online. You'll need your social security number, your bank account info, and that's basically it. Do this today, not tomorrow. Today, because every month you wait is a month of compound growth you're missing forever. Step 2. Set up automatic investments. This is non-negotiable. Decide how much you can afford per month, even if it's only $50, even if it's only $25. I don't care. Something is infinitely better than nothing. And set up an automatic transfer from your checking account to your brokerage account. Then set up automatic purchasing of your chosen S&P 500 index fund. I use VOO. Some people use SPY. Some use IVV. They're all basically identical. They all track the S&P 500. They all have fees under 0.1%, which is almost nothing. Pick one and forget about it. The automatic part is the key. Humans are terrible at making good decisions consistently, but we're pretty good at setting up systems and letting them run. Step 3, and this is the hardest one. Do nothing for decades. Don't check your account every day. Don't panic when the market drops 15% because some bank in Europe failed, or because the Fed raised interest rates, or because a pandemic happened, or because whatever the crisis of the month is. Don't try to time the market by selling high and buying low, because you won't. Nobody can. It's a myth. Just let it run. The money you invest today isn't money you're going to touch for 20 or 30 years. Between now and then, there will be at least 3 recessions. There will be at least 5 market corrections of 10% or more. There will be at least 1 crash that makes you feel physically sick when you see the numbers. And your job during all of that is to do absolutely nothing. Keep buying every month like clockwork. When the market is down, you're buying shares at a discount. When the market is up, you're capturing gains. Over the long term, the direction is up, always has been for 100 years. Probably will be for the next 100, assuming America continues to exist as a functioning country. Here's a mental model that helps me. When you invest in the S&P 500, you're not buying a stock. You're buying time. You're buying your future self the option to not work until you die. You're buying the possibility of retiring with dignity. You're buying freedom from financial anxiety at 65 or 70. Every dollar you invest today is $8 in 30 years at historical average returns. So that $4 coffee you didn't buy and instead invested becomes $32 in 30 years. That $60 cable package you canceled and invested becomes $480 in 30 years. This isn't about deprivation. This is about delayed gratification. This is about deciding that future bill is more important than current bill's minor conveniences. And look, I'm not going to lie to you and say this is easy. It's simple, but it's not easy. Simple means the instructions are straightforward. Easy means it doesn't require effort or discipline. This requires both. It requires you to override your instincts. It requires you to ignore the news that's screaming about market crashes. It requires you to not feel like an idiot when your friend tells you they made $10,000 day trading some meme stock. It requires you to be okay with boring. And in 2026, when everything is optimized for engagement and dopamine hits and instant gratification, being boring is actually radical. Being patient is revolutionary. Doing the same thing for 30 years without changing your mind is basically a superpower at this point. But here's what I keep coming back to. What's the alternative? Working until I'm 75 and then relying on Social Security, which in 2026 pays an average of about $1,900 per month, which is basically poverty. And hoping nothing expensive happens to me? That's not a plan. That's surrender. Or maybe trying to start a business which has like a 90% failure rate and requires working 100 hours a week for years with no guarantee of success. Or maybe winning the lottery, which has odds of 1 in 300 million. Or maybe marrying rich, which I'm too old and cynical and not nearly attractive enough to pull off at this point. No, the realistic path to retirement for normal people is the S&P 500. It's not sexy. It won't make you an overnight millionaire. It won't give you anything to brag about at parties. But it works, consistently, predictably, boringly, and boring is exactly what you want when it comes to building wealth. Excitement in finance usually means you're losing money. Boredom means the plan is working. I think about my dad sometimes. He worked his whole life at a factory that closed down when he was 56, took whatever jobs he could get after that, never had a retirement plan beyond hoping Social Security would be enough. Died at 71 with almost nothing to leave behind except that truck. And I love my dad, and he did the best he could with what he knew, but I'm not doing that. I'm not working until my body gives out and then hoping the government takes care of me. I'm putting $250 per month into VOO every single month until I'm 65, and based on the historical returns, I should have somewhere around $800,000, which isn't private jet money, but I can stop working and not worry about making rent money. That's the goal, not wealth, security. And if you're sitting here thinking, Bill, I'm 50 years old, is it too late for me? No, it's not. It's not optimal. You don't have as much time for compound growth to work its magic. But doing this for 15 years is infinitely better than doing it for 0 years. If you invest $500 per month for 15 years at 10% returns, you'll have about $200,000. That's not enough to retire on by itself, but combined with Social Security and maybe a paid-off house, it's the difference between barely surviving and actually okay. The best time to start was 20 years ago. The second best time is right now, today, this afternoon. Let me address one more thing because I know people are going to ask. What about taxes? Great question. If you invest in a regular brokerage account, you'll pay capital gains taxes when you sell, which is either 15 or 20% depending on your income bracket. But here's the beautiful trick that the government actually gives you. It's called a Roth IRA. You can contribute up to $7,000 per year if you're under 50, or $8,000 if you're over 50. The money goes in after taxes, so you already paid income tax on it. But then it grows tax-free. And when you withdraw it after age 59 and a half, you pay zero taxes on the gains. Zero. So if you put in $7,000 per year for 30 years, that's $210,000 you contributed. But at 10% growth, it's worth over $1.2 million. And you get to keep all $1.2 million. The IRS doesn't get a cut. This is the single best retirement account available to normal people, and if you're not maxing out your Roth IRA every year, you're leaving free money on the table. If your employer offers a 401k with matching, that's even better. That's your employer literally giving you free money. If they match 50% up to 6% of your salary and you make $60,000 a year, you should be putting in $3,600 per year, and they'll add another $1,800 for free. That's a 50% immediate return before the market does anything. And most 401k plans offer an S&P 500 index fund option. Do that, max out the match at minimum. If you can, max out the entire 401k contribution limit, which in 2026 is $23,000 per year if you're under 50. I know that sounds like a lot. Most people can't do that, but even doing 10% of your salary is huge. Here's my personal setup since you're probably wondering. I max out my Roth IRA first, $7,000 per year, which is about $583 per month. Then I put another $200 per month into my 401k at work, which my employer matches 50%, so that's actually $300 per month going into my 401k. Then I put another $250 into a regular taxable brokerage account. That's about $1,000 per month total going into the S&P 500 across 3 different accounts. Is it painful? Yes. Do I notice it? Honestly, not anymore. My brain adjusted. I live on what's left. And in 23 years, when I'm 65, assuming historical returns hold, I should have around $2 million. That's not a guess. That's math. That's compound interest doing what compound interest does. The psychological part is harder than the mechanical part. The hard part isn't opening the account or setting up the automatic transfer. The hard part is not touching it, not panicking, not selling when your buddy tells you the market is going to crash, not getting FOMO when crypto is rallying and you feel like you're missing out, not feeling stupid when the market drops 20% and your account goes from $50,000 to $40,000. Because that's going to happen multiple times, and every single time, your lizard brain is going to scream at you to sell, to cut your losses, to get out before it gets worse. And every single time, that lizard brain will be wrong. Because every single market crash in history has eventually recovered and gone on to make new highs. Let me give you one specific example that illustrates this perfectly. In March 2020, when COVID hit and everything shut down, the S&P 500 dropped from 3,400 to 2,200 in about 3 weeks. That's a 34% loss. If you had $100,000 invested, you watched it become $66,000. That's terrifying. That's a new car you just lost. That's a year of your kid's college tuition gone. And people panic sold. They locked in those losses. They swore they'd never invest again. And you know what happened? 6 months later, the market was back to 3,400. 1 year later, it was at 4,200. 2 years later, it was at 4,800. The people who held on, or better yet, the people who kept buying during the crash, they made money. The people who sold got destroyed. This is the game. The game is not picking the right stocks. The game is not timing the market. The game is controlling your emotions. The game is doing nothing when your instincts tell you to do something. Warren Buffett, who is worth like $100 billion and is basically the most successful investor in history, his advice for normal people is to buy the S&P 500 and never sell it. That's it. That's his whole recommendation. He doesn't tell you to pick stocks. He doesn't tell you to try to time the market. He says buy the index and chill. And people still don't listen. Because it sounds too easy, it sounds too boring, it sounds like there must be something more to it. There isn't. I want to be really clear about something else. This is not financial advice. I am not a financial advisor. I am a guy who fixes toilets and has made a lot of mistakes with money and is trying to share what I've learned so you don't make the same mistakes. You should do your own research. You should talk to a real financial advisor if you have complex needs. But if you're a regular person with a regular job who just wants to retire someday without eating ramen noodles in a studio apartment, the S&P 500 is the closest thing to a guaranteed path that exists in finance. It's not actually guaranteed. Nothing in the market is guaranteed, but it's about as close as you can get. And here's the thing that keeps me up at night sometimes. Most Americans are going to retire broke. Not because they didn't work hard, not because they weren't smart, but because nobody taught them this. Nobody sat them down at age 22 and said, hey, take 10% of every paycheck and put it in an S&P 500 index fund and don't touch it for 40 years. Nobody explained compound interest in a way that actually made sense. Nobody showed them the actual math of what happens when you save consistently over decades. And so people spend everything they make, or they chase get-rich-quick schemes, or they buy lottery tickets, or they just assume it'll somehow work out, and then they hit 65 and realize they have nothing and it's too late to fix it. I don't want that to be you. I don't want that to be me. And the brutal truth is that if you're reading this and you're under 40, you still have time to completely change your financial future. 20 or 30 years of consistent investing in the S&P 500 will make you financially secure, not rich. Not private jet rich, but secure, comfortable, free from the anxiety of wondering how you'll pay bills when you're too old to work. And that's worth more than any momentary pleasure you get from buying stuff you don't need. So here's my challenge to you, and I'm saying this as someone who screwed this up for 2 decades before figuring it out. Open a brokerage account this week. Set up a Roth IRA if you don't have one. Pick an S&P 500 index fund, VOO, SPY, IVV, doesn't matter which one. They're all basically the same. Set up automatic monthly investing for whatever amount you can actually afford without going into debt. Even if it's $25, even if it's $50, just start. And then forget about it. Don't check it obsessively. Don't panic when the market drops. Don't try to time it. Just let the machine run. Let compound interest do what it does. Let time be your friend instead of your enemy. And in 20 years or 30 years, when you're looking at a 7-figure account balance and you realize you can actually retire, you can actually stop working, you can actually have freedom, you'll think back to right now, to this exact moment when you made the decision to stop screwing around and start building wealth the boring way, and you'll be glad you did. Future you will thank current you, I promise. The laziest way to get rich is to buy the S&P 500 and do nothing for decades. It's not exciting, it won't make you feel smart, but it works. It's always worked. And unless America completely collapses, in which case we've got bigger problems than investment returns, it'll keep working. So stop looking for the secret. Stop trying to outsmart the system. Just buy the index, set it and forget it, and let capitalism do what capitalism does best, which is grow over time. That's it. That's the whole thing. I'm going to finish this beer now and watch something mindless on Netflix because I've spent enough mental energy on this for one night. But I'll sleep better knowing that while I'm watching TV, my money is working, compounding, growing, building the future I want instead of the future I'm afraid of. And if you actually do what I've laid out here, you'll sleep better too. Not because you're getting rich quick, but because you're getting rich slow, which is the only way that actually works for people like us.